I'm going to tell you about a long-standing cybersecurity holding, CrowdStrike, ticker CRWD. It's a global cybersecurity leader that provides a cloud-native platform, and they're a leader in like modern AI native cybersecurity. The platform's built in the cloud, and they deploy a single lightweight agent to each device, and that makes it really easy for customers to deploy their solution. You don't even have to like power cycle, like turn it off and on again. You just install the agent and you're away, and you're being protected by CrowdStrike. And all of this data, trillions and trillions of events of monitoring, get streamed in real time to CrowdStrike's central threat graph, where they use AI and also humans in their security operations centers to analyze and stop threats, detecting malicious behaviors while they're happening without impacting device performance. And the beauty of this kind of cloud-based solution is if they detect a breach and then they close that for one customer in real time, like within minutes, they can be rolling out or making the same fix available to all their customers. So you've got this incredibly powerful network effect. Every customer is like another risk point, but if they get breached, everybody else gets the benefit of the solution to that. They did some really clever kind of financial engineering, or at least like sales engineering, a year or two ago, and they launched something called Falcon Flex. So Falcon Flex is essentially customers can now buy a certain level of spend over a multi-year term, and then they just kind of draw down it or on it for the modules they want. Because CrowdStrike now has over 30 different components to their solution. So rather than customers and the procurement teams having to work out, okay, we're going to buy like these different Lego blocks for our solution, they just say, okay, we're going to spend, X million dollars, and then we'll use the bits that we need. And it's really easy for the buyers to like buy the thing and then the engineers to use it. And a good example of that in practice is they recently disclosed that one of their Fortune 100 clients scaled their spend from 12 million to over $100 million within a couple of months of coming on board with Falcon Flex. So customers really like the flexibility. Now, this is only 4 badges out of 10 for me, even though I consider it a core stock and if you put the valuation aside, a very high conviction investment in a very high conviction segment. But the valuation is frankly egregious. It's now 28 times sales, which is going to sound like nothing when I tell you about Palantir in a minute. But like both of these companies, I've just been trimming pretty aggressively in the last year. I really like the company, but I don't really like the stock at this price.
Yeah, so interesting that a company that is beloved to us both gets 4 badgers due to valuation. I mean, I am getting 21 vibes, late 21 vibes in this,
For sure.
sector. I wonder. I mean, it seems to me, based on your own investing history, whether you're taking the lessons from 21 and trying to actively apply them. In this sense, you're trimming because, as to quote you, the valuation is egregious, but it's not but you dare not sell out of it completely like yours truly did.
I think let me jump in there because I think that is a really it's a great way to navigate companies like this. Like if you really truly believe in the long term, which I do, like remain an owner, but just manage your exposure to it. Like I bought, if I just look back at my own history with this thing, right? I bought CrowdStrike 5 times between 2021 and 2023. And those are all like multi-bagger returns. The later returns are like 4x returns on like a reasonably sized investment for me. But when the valuation started to get away, I've trimmed it. The last 4 transactions are all trims, most recently, actually, just last month. Because, and each one of those trims has been a mistake in the rearview mirror. Like my first trim, the stock has doubled since then. But I just want to manage my exposure. And I think it takes away like the problem you put yourself in, the quandary you gave yourself when you sold a bunch of really high quality companies because you were trying to time your way back in at the bottom. And if you miss the bottom, well, or if the stock just continues to go up, as this one did, like you kind of never get back in. And if you trim, like you've got still got skin in the game, it just sort of mitigates that like price anchoring. because you're like, okay, I've got some, and if the company continues to perform as it does, and if the valuation gets more reasonable, well, like I've got some, I can add a bit more, and I can just add a bit, trim a bit, and just kind of nudge it towards an exposure level that's appropriate to your conviction. I think that's a really mature way of managing a portfolio.
I don't think I ever confessed this to you, but I bought, I think, a small amount of shares after the what's it called, the major airport bug that stopped the world. But then I sold it again, taking I took a quick little profit. I had other places to reinvest it in that have since doubled, so it was fine. It was good, but that reminds me, has the impact from that major catastrophe already been completely processed, and like things are totally fine? Water under the bridge, nothing to see here, kind of thing.
We'd have to go like much deeper into the numbers and have a much longer whole conversation to tell the story. But at a high level, that like the valuation has just like continued to charge on. So it's like investors have kind of ignored it. In terms of like billings and revenue, it has slowed, and there was definitely like a bump in revenue growth as a consequence of that outage. But we're now more than a year past that, I think, or coming up to a year. So like, it's always like comparables can be quite difficult with tech companies, particularly highly valued ones, where you're basically looking at, what was some number a year ago versus today. And if you had like a really good year last year, well, like the comparables are quite hard. It's tough, particularly if you've had like a major incident like that. So that's why the valuation has kind of diverged from reality a little bit, because the market cap has continued to go up at a steady pace, but the revenue growth has trailed off a little bit. But long term, like I said, like this currently, it was like a 6 or 7% allocation for me in my real money portfolio. It's now a 2.5% allocation. That's like just feels like a comfortable level to me. And it's not like a big deal. It's not like I've gone like turned the light bulb on and off. I've just got like a dimmer switch. So that's that sort of thing. And if the valuation gets better, like it's easy for me just to add a little bit more to my 2.5% allocation, like turn the brightness up a little bit, as opposed to going from owning nothing and then trying to pick that point, like boom, have I timed it to suddenly become an owner again? I just find it easier to navigate that emotionally, if nothing else.
Yeah, good point. I know exactly what you're talking about. All right.